Something just happened in the memory chip market that's quietly putting pressure on some of the biggest names in tech. Sadly, most investors aren't connecting the dots, but gladly, by listening to what I have to say over the next few minutes, you'll be well ahead of the pack. As most of you know, Micron just announced another blowout earnings result that confirmed the memory boom is still on fire. This is a surprise to no one following this channel, as we have been pounding the table on Micron and SanDisk for quite some time. But perhaps the more interesting part of the story is the harm it might be causing to other high-profile tech stocks. And that's what we're going to dig into today. By the way, I'm Steve Reitmeister. I've been investing for over 40 years, almost half that time as editor-in-chief of Zacks.com, and now I'm a partner at WallStreetZen, where I help develop a quant rating system and manage the Zen Investor stock picking newsletter. If you like timely market insight and top picks, then please give this video a like. It helps me out a lot. Much appreciated. All right. But before I start talking about the specific stocks, let me remind you, this is not personalized investment advice. Always do your own due diligence. All right, let's start with a little backstory about the company that's kicked all of this off. All right, we're talking about Micron Technology with the symbol of MU. It's the largest U.S.-based manufacturer of memory chips. All right, so specifically, they focus on DRAM and NAND flash, the types of memory that go into everything from data center servers to smartphones. Now, when AI infrastructure spending exploded over the past couple of years, demand for memory came right along for the rocket ride. And yes, Micron has been one of the biggest beneficiaries. Now, the most recent quarter was a blowout by any measure. A 4x increase in revenue, which translated into a 13x increase in earnings. Let me repeat that. Earnings grew 13-fold year over year. If that were not good enough, management then raised guidance once again for the quarter ahead. Now, Wall Street analysts have certainly taken notice with a slew of buy and strong buy recommendations, plus price targets seem to go up by the day, with analysts falling over each other to put the street high forecasts printed on the market. Right. Our Zen Ratings model continues to smile upon this stock, where it earns an elite A rating overall. It's easy to see why it's so highly rated when you look at the underlying component grades, which shape the overall rating. As of the week I'm recording, value is still in the top 13% of all stocks. I know that sounds crazy given how much shares have come up in the past year, but that 13x increase in earnings is why it's still undervalued. And not surprising is the A grades for growth, financial strength, momentum, and sentiment. All in the top 5% of the stocks we track for these vital categories. Now, the one flag is the D rating for safety, but that comes with the territory for more volatile stocks in the semiconductor space. When this current beat and raise streak ends, and at some point it will, the stock will give back gains quickly. So this is not a set and forget it kind of stock. Rather, it's an extreme momentum play. You need to use trailing stocks with the lock-in gains before they evaporate. All right. Let me also mention that since earnings, Micron has already jumped in price, and that is on top of an already handsome move in the past year. Not to say I told you so, but I actually first alerted investors to the stock back in December 2025. It's performed extremely well since then, to put it mildly. Now, if you want to spot more stocks like this before the big moves, then one solid step you could take is signing up for my next free live training session. The focus is on timely market insight plus my top stock picks, right? I invite you to join me for the next one this coming Monday at 7 p.m. Eastern Time. Now, it's free. Just sign up now at wallstreetzen.com/live. Now let's talk about the flip side, or the hidden cost of surging memory prices and demand. Think of the stock market like a sausage casing. It's definitely not infinitely expandable. If you jam more sausage in one side, then something has to fall out the other side, right? Same thing happens when memory prices surge. The companies that sell memory do great, but the companies that buy memory to put them inside servers, laptops, all their devices, suddenly face higher input costs. Now, they have two choices: absorb the costs and watch their profit margins shrink, or pass along to customers and risk killing demand. Neither option is great. Investors have been marking down the stocks the company's caught in this squeeze, and today I want to look at three of them, right? Stick around to the end because the last one is probably the stock in most of your portfolios, and you want to fully appreciate the impact of these events, right? So we're going to start with Dell Technologies with the symbol of DELL. Dell is one of the biggest buyers of memory chips on the planet. It has to be, and that's because they're one of the largest sellers of servers, PCs, and storage systems. Its infrastructure solution group has been on an absolute tear. Revenue grew 73% year over year last quarter, with an AI-optimized server sales up more than 300%. Now, investors have already rewarded shares. Dell stock has nearly doubled year to date, and the analyst consensus is still a buy. But here comes the but. All right? Here's the tension. Dell is a massive beneficiary of AI infrastructure spending, but it's also a massive consumer of memory. Now, when Micron's prices go up, Dell's costs go up too. And on hardware margins, which are thinner than most other areas of tech, that greatly matters. Case in point, the day Micron's earnings hit and MU shares soared 15%, Dell went the other way, falling 5% on that news. Let me be clear. Dell is still an impressive company. This comes in spades from the Zen Ratings quant model review of 115 different factors for every stock. Now, Dell is still A-rated, which is a strong buy recommendation. As we scan the component grades, it stands out with high marks for growth, sentiment, momentum. Now, each scoring the top 5% of all stocks. But given the long-run success for shares, then value is getting a little bit stretched and is now kind of middle of the road C rating. The bottom line on Dell all comes down to their ability to pass along the increased cost of memory. If they can, then the growth party continues, as does the share price gain party. Now, if not, then watch out below. By the way, if you're enjoying the insights from this video, then now would be a good time to subscribe and hit the notification bell. That's the best way to ensure you see the next videos I release. Now let's move on to Hewlett Packard Enterprises with a symbol of HPE. They sell into the same data center market, right? We're talking about server storage networking. It's also digesting the Juniper Networks acquisition, which strengthens its networking capabilities. Now, same memory cost headwind as Dell's, same roughly 5% sell-off when Micron's earnings dropped. Wall Street consensus is still a buy. As of the week I'm recording, 10 top-rated Wall Street analysts tracked on our website are pounding the table on shares. An upside target suggests that the stock could see over 70% upside potential in the coming year. Now, you can see the specific targets for this stock or any other on our quote pages at WallStreetZen.com. Once again, the Zen Ratings is quite fond of this stock, where HPE gets an elite A grade, which amounts to a strong buy recommendation. In this case, we have truly sparkling component grades, mostly A and B, but even the weakest, such as financials, are still in the top 40% of all stocks. My guess is that will improve over time as they use excess cash to pay down the debt used for the Juniper acquisition. HPE has the same basic promise Dell, that being their ability to pass along that higher memory cost, right? Definitely keep your eye on that situation. However, I will admit to having a much more favorable outlook for HPE because with all their growth, it's still an undervalued stock. In fact, HPE is in the top 20% of all stocks for value. That is why I continue to recommend it as a buy in my Zen Investor newsletter. And then we come to Apple. I don't need to tell you this symbol. Like I said, this one is in almost everyone's portfolio, so it has the most wide-reaching ramifications. Apple puts memory into nearly every product it makes. iPhones, MacBooks, iPads, right? Everything you can think of. Unlike Dell and HPE, Apple didn't absorb the higher memory costs. It raised prices on MacBooks and iPads, passing them straight on to consumers. Investors did not take kindly to that by chopping down shares, right? The question now is whether customers push back. Some analysts see this as a smart margin defense. Others see it as a demand risk. Now, right now, recommendations are mixed amongst analysts tracked on WallStreetZen, with a mixture of strong buy, and hold recommendations. On the more cautious side, some analysts forecast losses in the coming year for Apple. Others are more optimistic, with some price targets forecasting like 40% potential upside in the coming year. The Zen Ratings has a fairly cautious view on Apple, with only a C rating, which amounts to a hold recommendation. Okay, it has some bright spots, as you might imagine, is strong with financials. It also does well with our momentum and AI timeliness factor indicator. But they get marked down for two key areas, being the bottom 43% of all stocks for value and bottom 30% for growth. It's hard for me to recommend any stocks scoring so low in these vital areas. Now, what could change my mind on Apple? Improvements in these ratings, right? Gladly, the Zen Ratings are updated daily on WallStreetZen.com, so check in frequently to see how things develop over time for their shares or any other that you have your eyes on. Now, your next step should be to join me this coming Monday at 7 p.m. Eastern Time for the next live training session. That's when I give timely insights in the market direction and trading strategy, and this is also where I share my trade of the week, based on our proven Zen Ratings quant model and my greater than 40 years of investing experience. These sessions are free, but you do need to register to reserve a spot, so you can do that now by going to WallStreetZen.com/live, or use the QR code on your screen, or use the link in the description. or whichever suits you best, but whatever it takes, I look forward to seeing you there on Monday. Now let's talk about how you can move forward with your eyes wide open. Micron is the clear winner here, and the data backs it up, but it's a cyclical momentum play, not a forever buy and hold investment. The tripwire is simple. The moment they lower guidance or miss earnings, that's your signal to take profits off the table. Dell and HPE are both strong buys according to the Zen Ratings model, but as I noted, I have a preference for HPE. But the next earnings reports are going to be the real test for these two. The key is margins, not just the headline revenue and earnings numbers. If memory costs are eating into profitability, then that's likely where it will show up first, and that will be a sign to evacuate shares. Now, as for Apple, I'm on the sidelines until I see much better ratings for growth and value. So now let me turn the floor over to you. Do you agree with me on my assessment on these popular stocks, or do you see it another way? Please share your view in the comment section below for the benefit of our community. And if you like this video, then I strongly recommend another recent commentary where I talk about a crucial rotation that has already started in the market and where the smart money is moving now. That video is coming up on your screen now, so be sure to check it out.